So today's topic, today we finally start with the core topic really of that class, banking. And we start with basic banking. So let's see, I want to talk today about assets, liabilities, what banks do, and banks' economic functions. Reminder, most of the external finance that firms receive is not necessarily market-based funding, but it's typically bank funding here. So that's the reason why banks are very, very important for the economy. Without bank funding, lots of businesses basically won't receive sufficient finance to put through their new projects, to pay their employees, to basically function. So that's the reason why we want to focus so much on banks. When we talk about banks, we will use T accounts a lot. So several people of you already had accounting classes. For those of you who didn't, we will use a lot of T accounts. It's not difficult, but it's going to make our life easier. And therefore, it's important to know some basics. So I just made up a quick example with Mr. T here. So let's say a private person, they've got a certain amount of assets. Right? For example, he's got a big house, $3 million. Got even more bling, also $3 million. Then he's got a car or several cars and some cash. Right? So he's got a lot of assets. In this example here, he's got 333, so I guess it's 10 million. I'm making nice and easy numbers. And on the other side, the liability side, the question is, well, how did he finance all these assets? Where all these assets are coming from, basically? Where did he receive all that money from? And it turns out he borrowed quite a bit from Charlie, $3 million he borrowed, and the rest is his own money, or he financed himself. So that's his net worth. Or we can do it slightly different, what we will do a lot in this class. You add up all the assets and then subtract all the liabilities from it. And then if something is left over, it means you've got positive net worth, which is very important for companies. So if a company has not positive net worth, they are called insolvent. So you always want to have more assets than liabilities. If you have more debt than you have assets, you get into trouble sooner or later. The same thing for banks now. So here we've got a representative balance sheet for all the US banks, and they made this in percentages. And again, we can see on the right-hand side the sources of funds, and on the left-hand side, what are they're doing with these funds, the uses of funds. So these are the assets, liabilities. And again, we could add up all the assets, subtract all the liabilities from it, and what's left over is the net worth, or for banks, we call this also bank capital. And there's something here that I want to emphasize lots of times over the next few classes, and today lots of times too. Bank capital is not money. It's nothing physically lying around. It's also not a deposit account or anything like that, because it's written on the liability side. So it's where initially the funding came from. It's not the funding that is there still around. You could imagine, for example, here we can write on the left-hand side, let's say the bank invested all their funds simply to buy one building worth $100 million. They could have financed that 80% with liabilities. And then bank capital would have been exactly, they used 80% liability finance, borrowing. The leftover 20% we would call bank capital. Note that there's no cash lying around in my example. There's no money left over. All that they had in my example was just one building, nothing more. So bank capital is always on the right-hand side here with the liability side. It's never sticking around here on the left-hand side. And something that's frequently wrong in the newspapers, or politicians sometimes get that wrong too. They think bank capital is something that's lying around and can be lent to somebody else. It's not that way. For Australia, Combank, I don't want to pick on Combank, but they have been recently quite a lot on the news, so I thought it's quite suitable. Now for you, I want you to take a look at this balance sheet. What seems to be the most important asset? What's the biggest number here? Like if you have to describe to somebody, what is the typical asset of an Australian bank? So loans. Loans is a much bigger number than anything else. Right? So on the one hand side, banks are collecting money, and on the other side, they're giving out loans. Much more important than anything else. Then on the right-hand side, the liabilities. So where are these fundings coming from? What's the biggest important number there? deposits. So if you have a simplified bank, we can say, well, they're collecting deposits on one side and then lend out the money on the other side. That's a very simple bank. And we can see that in the real numbers here too. That's clearly the most important numbers. Then there's two other numbers that I will use in this class today. Cash. If you bring cash to your bank, you would think, well, a bank has lots of cash. All the bank robbers seem to think that banks have lots of cash. Right? That's the reason why they rock up trying to get that cash. If you look at the cash position, is that a big or a small number? Not for you to have, but on the balance sheet, small number, thank you. Right? So there's hardly any cash. Another thing that banks are famous for is huge buildings, very shiny buildings in the major capital cities, obviously very expensive. How important are the buildings for the bank? So it doesn't say buildings anywhere, but it says a similar thing, property. So property is including all the buildings, and we can see there it is less than 4%, I would say. Again, tiny, right? Even though the buildings are very expensive, tiny. So a bank really can be simplified, depict deposits in, loans out. But there's something else that is important. So I already focused on cash. Here also around 4%, so there's not much cash lying around. And then there's one third position that is important to me, and that is bank capital. Now, on this one, it doesn't say bank capital anywhere, but it says something similar. Net assets, which is the same thing as bank capital or equity. So it's simply all the assets minus all the liabilities, so finance that is owed to other people, and that gives us net asset. And again, if you see that as a percentage here, tiny, relatively small. That is less than 10%. Right, so very little bank capital. By the way, anybody has a feeling for normal corporations, how much capital they would use in percentage? Last number I've looked up is around 60% usually for a normal company. So a normal company has like 60% equity and 40% debt finance. While for a bank, there's hardly any equity finance here, right? It's mostly they finance themselves by borrowing money and borrowing money from depositors. So now we want to go step by step. The banking. So simplified balance sheet here. 100 deposits, 100 vault cash, assets and liability side must always be balanced, right? That's the reason why it's called a balance sheet. So don't make any errors in any exams in the future, any kind of task that you have. And if you've got more assets than debt, the difference is simply bank capital, net worth. Cash reserves, as we said beforehand, cash is very little amount in a typical bank, but there's some regulations. So in the US and Europe, they have to hold cash reserves, it's called. And the cash reserves are held on the left-hand side, right? So that's literally either cash lying around in the vault, then it's called vault cash, or the alternative is that they are bringing the cash to the central bank, and then they're having an account at the central bank, which we'll do in more detail in a second. Depending on what book you're reading here, you can read cash here, reserves, we will call that exchange settlement funds in a second, exchange settlement accounts, all means the same thing. So that's something that is very close to cash on the left-hand side. In Australia, as I said, the reserves are called exchange settlement funds, and also part of the reserve is simply vault cash. The whole point of these funds is that they are very, very liquid, which we'll see in a second too. Let's make an example, deposit transfers. And in this example here, there's a deposit transfer within one bank. I transfer $70 to the supermarket, so I basically went to the supermarket shopping, pulled out my card, paid my shopping $70 by card, and it happens to be by coincidence that the supermarket has their bank account also at the same bank. Now what happens now for the bank account? I initially had $100 on my bank account. Now that I paid the supermarket, of course, my account is going down by 70. So minus 70, and I end up with plus 30 here. And the $70 is basically going to the supermarket, which happened to be at the same bank. So now their deposits are increasing by 70. And what you can see here also for the bank, two things. Number one, total amount of deposits for the banks didn't change at all. We just changed the names associated to these deposits. So that's very easy for the bank. Number two, there's also no change on the assets here at all. So all that we changed is we noted, okay, we don't owe $100 to AXA anymore, we just owe him 30, but therefore we owe the supermarket 70 as well. Total debt still 100. Now, what's the important economic functions here? Banks help us make payments much easier. So I don't have to carry cash around all the time. Nobody can steal it very easily from me, as opposed to running around with cash. I really don't have to count it. I just pull out my card, tap it, be done with. The supermarket doesn't have to count in the evening the money because it's all electric done. Nobody can steal the money from the supermarket because it's straight on their bank account. And you can imagine for large sums, if you're buying a car, $20,000, $30,000, $40,000, doing it in cash will, of course, be a disaster. So life is much easier with these electronic payments. Next example, now we're getting a little bit trickier. So we have an example here where I'm still transferring money off my account, $70, but this time the supermarket has their bank account at another bank. So it's getting a bit more trickier. Again, the money is going off my account, so clearly I will have, after shopping, only $30 left on my account, not anymore. But the question is, where are the $70 going? So if I pay at the supermarket and the supermarket has their bank account at a different bank, somehow something must happen between these two banks. Now, if you would think very, very simple, somebody at Second National Bank might jump in the car with $70 in their pocket, drive over to the other bank, First National Bank, give them the money. That's, of course, never happening. They're not quick enough, doesn't make any sense. But somehow they have to book it from the time that I paid at the supermarket by card till the time everything is finished. And we're doing this in 2 steps. Step number 1 is clearing. Step number 2 is settlement. Step number 1, clearing, basically just means that there's communication, information flow between me, the supermarket, and the banks that something is happening here. The information that's flowing, money should go off my account. That's what the bank can do itself. Money should go onto the supermarket account or at the other bank. That is what Second National Bank can't do immediately. It takes time somehow to get it over there. But what they can do immediately is they can send information to First National Bank and say, listen, $70 is on its way towards you. And they can also at the same time write down, we have to pay the other bank $70, we still owe them. And of course the supermarket bank here can notify already that the supermarket will get $70 very soon because they've got that information. And here on the asset side they can write down, well, we will get from Second National Bank $70 very soon. So this is what happens in the first instance. That's clearing. That happens several times a day. That happens very fast. What we can see here now, we're not finished. Because what basically happened now is that Second National Bank owes First National Bank. And just like any security, if you owe somebody something for the other side, that means it's an asset because they know they get something. It's valuable to them. So that was the clearing. And now on the next step, we have to somehow settle. By the way, trick question, am I settled with the supermarket? Do I have any more dealings with the supermarket? I put my card on the card reader, it got approved, I've got my shopping, went to the car. Will the supermarket call me next day, do any kind of things with me, or am I done? I'm done. Well, I'm personally settled already at the supermarket, but the banks are not settled with each other yet. So how do banks settle with each other? All Australian banks have an account at the Reserve Bank of Australia, which is the Central Bank of Australia. And I think all of you had macro classes already, so the RBA, you've heard of them already, but now we look at them for the payment system. So all the banks have accounts there, and just as we have a deposit account in our bank, all the banks have deposit accounts at the RBA, but these deposit accounts are called Exchange Settlement Accounts, ESA. And on them, they have so-called exchange settlement funds. So now they want to settle. Second National Bank wants to repay its debt. So Second National Bank is transferring now $70 of its ESF funds over to First National Bank. So First National Bank is getting these funds at the RBA. Second National Bank is losing these funds on their account. So now they've paid them. That means that here they can say, okay, we don't have any outstanding debt anymore, but again, the balance sheet needs to be balanced. So we have to subtract the $70 here from their cash or ESA account. So you can see in my class I have cash, ESA, ESF account at the RBA, all the same thing. Reserves, all the same thing. It always means very liquid assets here that we can use to pay other banks. And here for the other bank, it's kind of the flip side. So they used to have the asset that they will get something from Second National Bank. Now that they've got it, they lose the right to get more, but therefore they've received the $70 over here. Now we are cleared and settled. Money off my account, money onto the supermarket account, and the banks between themselves have settled everything too. Good. So what did we get out of that one? For us, basically, we can use our deposit accounts and bank money as if it is cash. Right? If I send deposits over to somebody else, let's say if I pay you $100 via my deposit account, you're going to be perfectly happy. If I give you $100 on your deposit account or $100 in cash, I'm quite sure you say it's the same thing. It doesn't make a difference for you. But it does make a difference for banks. Banks don't accept each other deposits. The only kind of deposit transfer that banks accept between themselves is RBA transfers. So ESF. ESF is special in that sense. And if I link it up a little with macroeconomics, in macroeconomics you would have called this one monetary base. It's part of the monetary base or high-powered money. So there's something special to it. Good. That's the reason also why central banks are called banks of banks. So every bank has an account at the central bank. Your turn finally. So practicing what we just did. So we are transferring $5 from ANZ to NAB. So these are the accounts beforehand, what happened afterwards, after the transfer, and NAB what happens afterwards, and what happened to the RBA. You can either do it in step-by-step, clearing and afterwards settlement, or you can do it in one wash, if you already understood what's going on. for this class here, ESA, ESF, same thing. I don't make a difference there. Even reserves, same thing too. Now with reserves, one word of warning, if you had advanced accounting classes, there's something called capital reserves, totally different to what we have here. So don't mix them up. For when I talk in this class here about reserves and cash, we always mean on the left-hand side, liquid reserves, ESF. I transferred $5, so clearly my deposit account must go down by 5. So it's minus 5. 95 is the new number here. And now somehow ANZ has to pay NAB. We can either do it in 2 steps. Then we say, okay, this is 95, and now they owe NAB $5. And then it takes time till settlement, so they're gone. Or we just do it straight in one go, which is quicker and easier for us here. So you can just say, okay, NZ is paying NAB by simply booking ESF accounts of their ESF account here towards the NAB ESF account. So it's going to be, wait a second, first we should do this one here too. So ESF ANZ is, of course, here the initial 5. And for NAB, they've got 10 sitting there. So you can see here, there's always somewhere counter booking. Somebody's assets is automatically somebody else's liability. There's no other way around it. For example, for the bank, loans are an asset. For you as a customer, if you have a loan with a bank, it's a liability. Right? It's always the flip side. Same as here. So they've got an asset ESF. That means the RBA owes them the ESF. What do we have? 5, 10. Now they're transferring the 5 over, so this one becomes 0. And the 10 becomes 10 plus 5, 15. And we had here the 95 already. ESF is now 0 because they transferred their 5 over to NAB. Now NAB realizes that they have received 5 additional ESF. So they're sitting now here at 10 plus 5, 15. And it was for the customer. They had 110 plus 5, 115. Always balanced.